Gentlemen, can you hear? Ladies and gentlemen, good afternoon and welcome to today's presentation on the application of IFRS 17 in Korea, especially on the insurance contract. My name is ChunHo, Technical Director of the Korea Accounting Standards Board. I'm very pleased to be here and to have the opportunity to present issues related to reinsurance accounting in Korea. During this session, we will review the key principles of IFRS 17 and the practice in Korea related to reinsurance accounting. I understand that Nepal is going to adopt IFRS 17 soon. Therefore, in this session, I'd like to present the main practical issues related to reinsurance that have arisen in the implementation of IFRS 17 in Korea. The review of these issues and the accounting policies that have been decided as a result of this review. My presentation is divided into 4 sections. The first section, overview, focuses on the requirement of IFRS 17 for the insurance contract held. In this section, I will provide a brief overview of the requirement that IFRS 17 imposes on the insurance contract held. The second section, IFRS 17's effect on the insurers, examines how the insurers in Korea have been affected by the adoption of IFRS 17. In the third section, key accounting policies of reinsurer, we will look at the issues that the Korean reinsurer has faced in applying IFRS 17 to reinsurance contract and the accounting policies that the reinsurer has adopted to address them from a practical perspective. Finally, in the first section, I will answer questions on the application of IFRS 17 to reinsurance contract. These questions were sent to us by stakeholders in Nepal. As a reminder, the first section overview explains the accounting for reinsurance contract held by cedent. The remaining sections focus mainly on accounting for reinsurance contracts issued by reinsurers. Let's move on to the first section. As mentioned earlier, this section focuses on the requirement IFRS 17 for accounting for reinsurance contract held by cedent. The content in this section is based on some resources provided by the IFRS Foundation. And in addition to this content, I have added some accounting cases to enhance your understanding of the requirement of IFRS 17. I'm sure everyone here is already very familiar with the requirement of IFRS 17, but please remember I'm from the KASB, which is an accounting standard setter. Therefore, I think it's my duty to explain the theoretical content of IFRS 17. I hope you will listen to it as a refresher. Let's start with the scope of IFRS 17. IFRS 17 applies to insurance contract issued, including reinsurance contract issued, and reinsurance contract held and investment contract with discretionary participation features. For reinsurance contract held, IFRS 17 requires the application of general measurement model with certain modifications to reflect the features of the contract. However, for reinsurance contract issued, IFRS 17 requires the general measurement model to be applied in the same way as for insurance contracts issued. Of course, the premium allocation approach, which is a simplified measurement approach, can be applied to both. So Next slide provides a high-level summary of the relationship between the policyholder, the cedant, and the reinsurer. The cedant issues insurance contract to policyholders and receives premiums from policyholders and agrees to pay compensations for claims. The cedant purchases a reinsurance contract from the reinsurer. The cedant agrees to pay premiums to the reinsurer and receives reimbursement from the reinsurer in the event of claims. For the underlying insurance contract, a reinsurance contract may provide coverage for a single underlying insurance contract or a group of underlying insurance contracts issued by the cedant. A reinsurance contract that protects a cedant against claims arising from more than one underlying insurance contract is known as a reinsurance treaty. Some reinsurance contracts require a cedant to pay a portion of the premiums from the underlying insurance contract to reinsurers, and for the reinsurers to reimburse the cedant for the same proportion of claims. This is known as proportional reinsurance. Next, let's look at how each party transfers risk to the other using insurance contract. First, the policyholder transfers its risk to the insurer, known as the cedant, by purchasing an underlying insurance contract. The cedant assumes part of the risk transferred by the policyholder and transfers the remaining part of the risk for the insurer by purchasing a reinsurer's contract. Similarly, the reinsurer assumes a portion of this risk and transfers the remaining portions to the reinsurer or retrocessionaire. Through this process, each party to the transaction seeks to minimize risk by transferring it to its counterparty. This section focuses on how the cedant accounts for reinsurance contract held. The cedant recognizes measures and presents the insurance contract held separately from the underlying insurance contract. The insurance contract held are normally assets, whereas the underlying insurance contracts are normally liabilities. The following slide compares the accounting for the insurance contract held with the accounting for the insurance contract issued. The accounting for the insurance contract held is from the perspective of the cedant. NFRS 17 requires the cedant to apply the general measurement model with some modifications. On the other hand, accounting for the insurance contract issued is performed from the insurer's perspective. NFRS 17 requires the cedant to apply the general measurement model with some, NFRS 17 requires the insurers to apply the general measurement model, namely the bidding block approach, to the insurance contract in the same way as to insurance contract. This is because the insurance contracts are a type of insurance contract, and therefore the IASB believes that the insurers should apply the same requirement to the insurance contract issued as they apply to other insurance contracts issued by an issuer. However, NFRS 17 does not provide detailed guidance that reflects the characteristics of the insurance contract. As a result, the insurers in Korea struggled to apply the requirements of NFRS 17 to reinsurance contracts issued in practice, and after a long period of discussion, have finally developed accounting policies based on the principles of NFRS 17. In developing these accounting policies, they relied on the discussions in IASB's Insurers transition resource group. The accounting policies of the insurers in Korea are discussed in detail in the third section, significant accounting policies of reinsurers. The following slides show when to recognize and how to measure a reinsurance contract head. Let's first look at when reinsurance contract heads are recognized. A cedant measures a reinsurance contract head when it is initially recognized. The timing of a cedant recognition of reinsurance contract head depends on whether the reinsurance is proportional or non-proportional. Proportional reinsurance, which provides proportional coverage, is discussed in this slide. A cedant recognizes a group of proportional reinsurance contract head at the rate of 1, the beginning of the coverage period of the reinsurance contract, or the initial recognition of any underlying insurance contract. The example in this slide shows that the coverage period of the proportional reinsurance contract head begins before the initial recognition of the first underlying insurance contract. Accordingly, in an example, a reinsurance contract head is initially recognized on the date that the first underlying insurance contract is recognized. For all other reinsurance contract head, including non-proportional contracts, let's look at the illustration that explains when to recognize non-proportional reinsurance contract. In this diagram, the coverage period for the non-proportional reinsurance contract head begins before the recognition of any of the underlying insurance contract. Accordingly, the reinsurance contract head is recognized at the beginning of the coverage period, which is the earlier date. If you look at the general recognition requirements for insurance contracts issued set out below, you will see that these general requirements are modified for the insurance contract head. Having recognized the insurance contract head, we now need to measure those contracts. The following slide outlines the principle of the measurement requirement for the insurance contract head. This is the core requirement IFRS 17 as the sum of two components, the fulfillment cash flows and the contract service margin. This is also the case for reinsurance contract head. However, there are some modifications to the core requirement to reflect the economics of the reinsurance contract head. The first component of FCF is the present value of probability-weighted expected cash flows reflecting financial risk. FCF also includes a risk adjustment representing the amount of risk transferred to the reinsurer. The second component, the contractual service margin, represents the net cost or net gain of purchasing reinsurance contract. And the net gain or net cost is recognized as income or expense over the period of coverage. Meanwhile, for insurance contract issues, the CSM represents the earned profit or loss. In addition, if the insurance contract issued is expected to be onerous, which is similar to net cost, the insurer recognizes the loss immediately. The next slide describes the measurement requirement in more detail. Let's discuss the first component highlighted in the previous slide, the present value of future cash flows. We start by estimating the expected cash flows. Consistent assumptions with the underlying insurance contract must be used to estimate the cash flows of the insurance contract head. And the cedant is required to forecast cash flows within the reinsurance contract boundary consistent with the reinsurance contract issued. The boundary of reinsurance contract issued is to be addressed in Section 3. The boundary of cash flow may also include cash flows related to underlying insurance contract expected to be issued in the future. That's the change from the general measurement model for the insurance contract. In addition, the cedant needs to include the impact of any risk of non-performance by the reinsurer, including the effects of collateral and losses from litigation. In our jurisdiction, cedant measures this non-performance risk by analogy with the expected loss model in IFRS 9, which estimates expected credit losses using probability of default combined with loss given default. Then, in terms of discount rate, these expected cash flows are then discounted using rates that reflect the liquidity characteristics of the reinsurer's contract held. That is, these rates must reflect the time value of money, the cash flows characteristics, and the liquidity characteristics of the reinsurance contract held. We now move on to risk adjustment. The fulfillment cash flows of the reinsurance contract held also include a risk adjustment for non-financial risks. The purpose of the risk adjustment is to measure the amount of risk transferred from the cedant to the reinsurer. Although IFRS 17 does not specify the technique or methods that an entity should use to estimate the risk adjustment, the technique and method must meet the objective for the risk adjustment. Let's see the following illustration that shows the transfer of risks between the cedant and the reinsurer. Meanwhile, the risk adjustment for insurance contract issued is defined as the compensation an entity requires for bearing the uncertainty about the amount and timing of cash flows arising from non-financial risks. Having discussed the measurement of fulfillment cash flows, and now turn to the measurement of the contractual service margin on initial recognition. First, look at the diagram on the left. If the expected cash outflows to the reinsurer exceed the expected cash inflows plus RA, a net cost is identified. The net cost is amortized over the period of coverage as the cedant receives reinsurance service from the reinsurer. As a reminder, the insurance contract head is normally an asset. Therefore, the amortization of the CSM representing the net cost is recognized as expense. In the right hand, if the expected cash inflows from a reinsurer plus the risk adjustment exceed the expected cash outflows to the reinsurer, a net gain is identified. A net gain is amortized over the period of coverage as the cedant receives reinsurance service, and it is recognized as a profit. As I mentioned earlier, the contractual service margin on insurance contract issued represents the unearned profit for services yet to be provided. In addition, negative margin is not allowed, and the corresponding amount should be recognized as a loss immediately. This represents a change to the core measurement requirement IFRS 17 for the purpose of measuring the insurance contract held. The next slide uses a simple example to illustrate how the CSM of a reinsurance contract held is measured on initial recognition. In the reinsurance contract in this example, the cedant pays a fixed reinsurance premium to the reinsurer in exchange for the reinsurer's reimbursement of 30% of the claims paid to policyholders. On initial recognition, the insurer, that's to say cedant, measures the underlying insurance contract as shown in the table on the left. This results in CSM of 40, which represents an earned profit. On initial recognition, the measurement of the CSM of the insurance contract held is analyzed in two separate cases. In the first case, the cedant pays the insurance premium of $260 to the reinsurer. In the second case, the cedant pays the reinsurer a reinsurance premium of $300. In the first case, the sum of the cash inflows and the risk adjustment exceeds the cash outflows by 28, so CSM of 28 is measured, representing net gain. Next, considering the second case, we measure a CSM of 12 because the cash outflows exceeds the sum of the cash inflows and the risk adjustment by 12, and it represents a net cost. Since onerous contracts are not recognized at its inception for the insurance contract held, the CSM representing the net cost is allocated and recognized as an expense over the period of coverage. Let's move on to the level of obligation. A key requirement for the measurement of the contract service margin is the level of obligation. The insurance contract heads are aggregated into groups in accordance with the requirement for obligation of contract in NFRS 17, except that it cannot be onerous. For some reinsurance contract head, the application of the aggregation requirement could result in a group comprising a single contract. The aggregation requirement at the NFRS 17 level starts with a portfolio of the insurance contract held. A portfolio is defined as contracts with similar risks that are managed together. On initial recognition, a portfolio is divided into groups of the insurance contract held. First group that has a net gain of purchasing the insurance that represents a net cash inflow. Second group that has net cost of purchasing the insurance that represents net outflows with no significant possibility of becoming a net gain. And the third group that has any other net cost of purchasing the insurance that represents a net outflow. Also, on initial recognition, a cedant should not group the insurance contract purchased more than 1 year apart, and shall not reassess the group determined on initial recognition. This slide summarizes the subsequent measurement of the insurance contract held. We've talked about how we estimate the value of future cash flows and account for the risk adjustment based on our current assumptions at initial recognition. We have also gone through the CSM on initial recognition, which is the amount representing the net cost or net gain of purchasing the insurance contract. Subsequently, the present value of future cash flows and the risk adjustment are measured using current assumption, and at the date of initial recognition, the contract service margin is measured as the amount representing the net cost or net gain of purchasing the insurance. It is also updated to reflect the time value of money and to changes in expected future cash flows related to future service. And then by allocating an amount for services received and recognizing that amount in profit or less. However, there are some exceptions to general measurement model in relation to the subsequent measurement of CSM. I will skip them for the sake of time. This example is about subsequent measurement of CSM, but as I said earlier, because of the time limit, I will skip this example. Let's jump to the Let's jump to the slide 23. In this slide, we'll look at how the premium allocation approach is applied to reinsurance contract health. IFRS 17 sets out the following requirements for applying the PAA, namely, first, an entity reasonably expects that the resulting measurement method would not differ materially from the result of applying the general measurement model, that's to say, building block approach. Or second, the coverage period of each contract in the group is 1 year or less. The same requirement applies to reinsurers contract head, but there may be differences between the insurer's contract head and insurer's contract issued in whether they meet this condition for the PAA. A simple example compares the result of applying this condition for PAA to insurer's contract issued and the insurer's contract head. In the figure on the left, the group of contract in insurer's contract issued meets the PAA condition. That's because the individual contracts all have a coverage period of 1 year or less. However, in the figure on the right, the reinsurance contract head may not meet the PAA condition. That's because the group of contract consists of only one reinsurance contract head, which has a coverage period of 2 years and therefore doesn't meet the second condition. However, whether the contract meets the first condition and qualifies for PAA would depend on assessment of the facts and circumstance. I'm sorry, but there is a typo in this slide. Please swap criterion 1 and criterion 2. I'd like to keep this variety approach. Also, due to the time limit, I'd like skip presentation and disclosures. So far, we've been through the first section, overview, which covered the requirements of IFRS 17 for reinsurance contracts held by cedants. You may have found this a bit boring as it's all theoretical and probably something you are already familiar with. However, the second part is more practical, and I think you will find it more interesting than the first part. The topic of the second section is effect of IFRS 17 on reinsurer. And in this section, I will explain the financial effect of IFRS 17 on reinsurers in Korea. For your information, this section is based on discussion with experts at Korean Re, the largest reinsurer in Korea. Hereinafter, I will call it as the reinsurer. Let's start with the transition to IFRS 17. IFRS 17 provides 3 options for transition requirement. These 3 options are the full retrospective approach, the modified retrospective approach, and the fair value approach. The reinsurer has concluded that full retrospective approach is impracticable to apply. Therefore, it applied the modified retrospective approach to the insurance contract using the PAA. In addition, the fair value approach was used for the insurance contract using the building block approach. For the PAA approach, there are no significant difficulties in obtaining reasonable and supportable information due to the short duration of the coverage period. However, the reinsurer determined that they could not obtain sufficient information to apply the full retrospective approach and therefore decided to apply the modified retrospective approach. For the insurance contract using the BBA approach, they determined that neither the full retrospective approach nor the modified retrospective approach could be applied due to the large number of long-term contracts with long periods of coverage. The reinsurer determined that reasonable and supportable information necessary to use retrospective approach was not available. Therefore, it chose the remaining option, the fair value approach, as their accounting policy. We will not discuss the specific methodology required by IFRS 17, as the details of the transition requirements have been presented in another session earlier by my mate. For the insurance contract applying PAA, the measurement method previously applied under IFRS 4 was similar to PAA, and therefore the effect of the transition was not found to be significant. In applying the fair value approach, the reinsurer used measurement based on the Korea Insurance Capital Standard, in short KICS, a regulatory requirement as a proxy for fair value. The reinsurer believed that this measurement approximate fair value. The reinsurer noted that the party to whom the debt is transferred would require the supervisor's valuation as the transfer value. For the risk premium, which is part of the measurement on the KICS, the reinsurer has typically measured it much higher than the RA required by IFRS 17 due to the great uncertainty of the reinsurance contract. Therefore, as you can see in the figure on the left, the fair value proxy for insurance liabilities on the KICS exceeds the best estimate liability and the RA. Let's look at the impact of this on the transition. Firstly, a significant amount of CSM has been measured. Secondly, the amount of insurance liabilities measured on the KICS was greater than the amount measured on the IFRS 4, resulting in a reduction in retained earnings. However, in subsequent periods, profitability improved as a significant amount of CSM was amortized, resulting in the recognition of revenue. The following slide shows the effect of the adoption of IFRS 17 on the statement of financial position. Previously, on the IFRS 4, the insurers recognized the insurance receivables and the insurance payables. However, on the IFRS 17, these reinsurance receivables and payables are not recognized, but are reflected in estimates of future cash flows, resulting in the measurement of the insurance assets and the liabilities excluding this amount. The effect of this has been to reduce total assets and total liabilities. In addition, the fair value measurement of insurance liabilities has increased the volatility of net assets. Let's now look at the effect on the statement of financial performance. This slide shows how the financial statement of a reinsurer has changed with the adoption of IFRS 17. Firstly, insurance operational revenue, which was a sub-item of revenue under IFRS 4, and insurance operation expenses, which was a sub-item of expense, have been reclassified to insurance service result as insurance income and insurance expenses, respectively. In addition, under IFRS 17, the components of insurance revenue have been changed to include estimates of claims and other expenses incurred, risk adjustment releases, and CSM allocations. Moreover, foreign exchange gains and losses, which under IFRS 4 were included in insurance operating expenses, are now reported separately in insurance finance income or expense. Finally, on the IFRS 17, the effect of changes in the discount rate on insurance liabilities is separately identified and presented as OCI. Specifically, IFRS 17 has the following financial effects on the statement of financial performance. Firstly, It reduced insurance revenue and expenses due to the recognition of the investment component. Then it improved comparability by providing quantitative information on expected and actual insurance income and expenses. It also clarified the analysis of the underlying result by disaggregating the foreign exchange gain or loss from the insurance expense. Finally, it has improved the timeliness of the profit or loss by using current estimation. Let's move on to foreign exchange gain or loss. Under IFRS 4, the outstanding reserve, similar to the LRC in IFRS 17, was not considered to be a monetary item and therefore not subject to foreign currency translation. As though the claims reserve, similar to the LIC in IFRS 17, was accounted for as a foreign currency translation, it was included in the increase in insurance liabilities as a component of insurance operating expenses and was not presented separately. However, IFRS 17 extends the scope of foreign currency translation by adding LIC to monetary items. Changes in foreign currency insurance liabilities are now presented as an insurance service expense, and foreign exchange gain or losses are now presented separately as insurance financial income or expense, explicitly showing the impact of foreign exchange movement. This would provide more useful information to users of the financial statement. Next is the effect of the introduction of the concept of investment component. The investment component is defined as the amount that an insurance contract requires the entity to return to a policyholder in all circumstances, regardless of whether an insured event occurs. IFRS 17 requires the investment component to be excluded from insurance revenue and expenses. Under IFRS 4, insurance income and expenses were recognized on a cash basis, and the investment components was not separately identified. However, under IFRS 17, insurance income is recognized on accrual basis, and the investment component is excluded from insurance revenue and expenses. As mentioned earlier, the identification of the investment components has resulted in a decrease in the total amount insurance revenue and expenses compared to previous years. We have now completed section 1 and 2, and if you don't mind, why don't you take just 10 minutes break. I start again at 3:34. I start again at 3:40. Thank you. Let me start again. We have now reached the third section, key accounting policies for reinsurers. In this section, I'd like to present the accounting policies adopted by the reinsurer in applying IFRS 17. This is probably the section you will find most interesting. This section is also based on discussions with experts at Korean Re. The first accounting policy relates to the reinsurer's estimation of future cash flows from insurance contract issued. The issue is how to reasonably measure the underlying insurance contract when information about the underlying insurance contract is not available from the cedent. IFRS 17 establishes the principle that all available, reasonable, and supportable information should be used in estimating future cash flows. However, it does not provide a specific methodology for estimating future cash flows of reinsurance contract held, insurance contract issued, and it was not discussed even in the insurance transition resource group. Prior to the adoption of IFRS 17, industry practice was for the reinsurer to receive only a settlement letter from the cedent, which is a summary of the reinsurance premiums to be received and the reimbursement to be paid. Especially the time frame for receiving data from offshore cedents was longer. The reinsurer typically received invoices from offshore cedents more than 6 months after the cedent balance sheet date, which limited the reinsurer's ability to provide timely financial information on the insurance contract issued. For your information, paragraphs 33 and B37 are relevant to this issue. As an accounting policy, the reinsurer has established a model that averages some of the contract for which information is available. The reinsurer determined the accounting policy after consultation with its auditor. According to this accounting policy, for initial measurement, the reinsurer generates information on a hypothetical holding contract by sampling contract per case from informed contract. Let's look at the detailed procedure. First, the reinsurer creates a pool to generate information on the holding contract from data on similar treaties, and second, it extracts contract per case from the pool with the characteristics of the treaty, such as security class and underwriting year from the pool. Finally, it determines the sampling level so that the distribution of contracts in the sampling would be similar to the distribution of informed treaties. Then, for subsequent measurement, the reinsurer updates the data to the average of informed contracts at the measurement date by resampling. In addition, the reinsurer uses actuarial assumptions to estimate future cash flows by analogizing with the actual assumptions that were used to measure the treaties to which the sample belonged. The reinsurer has also considered using professional judgment to estimate the information and actuarial assumptions of the insurance contract issued. However, such judgment is not based on objective data and may lead to arbitrary measurement results. That's why this alternative was not adopted. In the meantime, if a sampling method is not available, the relevant information is estimated using industry average information provided by insurance-related organizations. The following few slides introduce an accounting policy regarding the presentation of of insurance finance income or expense. In other words, it is a matter of whether the reinsurer presents only profit or loss or present OCI in addition to profit or loss. The relevant paragraphs of IFRS 17 are paragraphs 88, 90, and BC 42. These paragraphs describe that an entity has an accounting policy choice regarding the presentation of profit or loss and OCI. As an accounting policy for this issue, the reinsurer has adopted the OCI approach, which separates insurance finance income between the profit or loss and OCI. In addition, the reinsurer presents the profit or loss using the interest rate at initial recognition, and the effect of the difference between the current interest rate and the locked-in interest rate is presented in OCI. This accounting policy is based on paragraph B131 and B72 of IFRS 17. You may wonder why the reinsurer has chosen this accounting policy. The first reason is the reinsurer's ALM policy. It has a large number of long-term bonds, and changes in the fair value of these financial instruments shall be recognized as OCI. Therefore, it is necessary to present OCI on the liability side as well. In the case of reinsurance contract in Korea, most of them are non-participating contracts. Therefore, changes in assumptions related to financial risks do not have a significant effect on the insurance contract. However, the reinsurer said it plans to allocate insurance finance income or expense using the effective aid approach when participating contracts are ceded to the reinsurer in the future. The next accounting policy addresses how to determine the portfolio of reinsurance contracts issued. Paragraph 14 of IFRS 17 describes a portfolio as contracts that are subject to similar risks and are managed together. Generally, a treaty covers different types of risks from underlying insurance contract. Therefore, it's very difficult to determine a portfolio for some treaties that covers all underlying insurance contracts. In reviewing its accounting policy for portfolio setting, the reinsurer considered various methods. One of the methods considered was a method which involves separating all the different policies within each contract from the contract and regrouping policies with similar risk characteristics. However, this approach was rejected as too difficult to apply in practice and not appropriate from a cost-benefit perspective. The reinsurer has established an accounting policy for the portfolio in accordance with the criteria for the underlying insurance contracts after considering the risks and ways of management. The first consideration in setting a portfolio is similar risk. Two alternatives have been considered regarding the similar risk. The first alternative is to identify the representative risk of a particular treaty and classify it according to the portfolio classification criteria for the underlying insurance contract. The second alternative is to group all the insurance treaties into a portfolio called composite risk. In particular, the reinsurer was concerned that the second alternative may not be consistent with the portfolio concept in IFRS 17. Ultimately, it was concluded that the reinsurer should apply the first alternative in principle, but the second alternative for contracts where it's difficult to identify the representative risk. The second consideration is managed together with respect to the second consideration. It is concluded that the reinsurer should group treaties classified by representative risk into proportional and non-proportional, based on the way in which responsibility is shared. Considering that proportional and non-proportional contracts are managed separately due to the different way in which responsibility is shared. Let's look at the actual portfolio structure of the reinsurer. The table on the left shows the portfolio categorization of underlying insurance contract. Let's take a look at life insurance. Firstly, on the basis of similar risk criteria, death, health, pension savings, and others. Then, based on the managed together criteria, insurers divide them portfolios into non-participating, participating, and variable. As explained earlier, the classification criteria for underlying insurance contract in relation to the similar risk criterion are used for the classification of the insurance contract. As can be seen from this table, life insurance, long-term non-life insurance, and general non-life insurance are all classified on the same basis as the underlying insurance contract in the insurance contract categorization. In relation to the managed together criterion, the reinsurer distinguish between portfolio based on whether they are proportional or non-proportional. In other words, the cedant creates a portfolio by reclassifying the groups that the cedant has classified under the similar risk criterion as proportional or non-proportional. Now let's examine the accounting policy for the accounting unit or group of contract within the portfolio. To begin with the result, the reinsurer sets up single reinsurance contract, such as treaty, as a group of contract. From a reinsurance perspective, the contract is a single contract, even though it contains a number of ceded policies. The reinsurer was concerned that determining the group of contract based on the policies in the contract might not be in accordance with the principles of IFRS 17. This is because the smallest unit of accounting in IFRS 17 is the individual contract. However, it considers that the group of contract is subject to the annual cohort requirement in IFRS 17. As a result, it generally determines the group of contract in a portfolio based on the underwriting year of the underlying insurance contract ceded. Currently, IFRS 17 does not provide a specific definition of a group of contract applicable to reinsurance contract, which led the reinsurer to develop this accounting policy. The relevant paragraphs in IFRS 17 relating to a group of contract are paragraphs 16 and 22. Next, let's look at the accounting policy on the contract boundary of the insurer's contract. According to the reinsurer, a lot of time and effort has gone into developing this accounting policy. As IFRS 17 introduces new concept that did not exist in previous insurance accounting standard, there has been a lot of discussion among industry stakeholders to understand and apply them in practice. And the IASB's insurance TIG has been closely consulted in this process. The boundaries of this reinsurance contract are the same for both reinsurance contract held and reinsurance contract issued. I'll explain the details in the following slides. Let's start with the concept of contract boundary. Cash flows are within the boundary of an insurance contract if they arise from substantive rights and obligations that exist during the reporting period in which the entity can compel the policyholder to pay the premiums, or in which the entity has a substantive obligation to provide services to the policyholder with the insurer's contract services. Clear identification of contract boundary is critical because the insurers can only recognize insurance assets and insurance liabilities for cash flows that fall within the boundary of the insurance contract. In addition, paragraph 34 of IFRS 17 explains the conditions under which a substantive obligation to provide service ends. This table summarizes the definition and the termination of the rights and obligations of the insurer, cedant, and reinsurer in the underlying insurer's contract, the insurer's contract held, and the reinsurance contract issued. As explained above, whether these rights and obligations end determines the boundary of the contract. The contractual relationships included in this table are as follows. First, the cedant and the policyholder enter into an insurance contract so that the insurer has rights and obligations to the policyholder under the underlying insurance contract. In addition, the cedant enters into a reinsurance contract with the reinsurer, so the cedant has rights and obligations under the reinsurance contract. From the cedant perspective, the contract is a reinsurance contract held. The reinsurer also has rights and obligations to the cedant under the reinsurance contract. From the reinsurer's perspective, the contract is a reinsurance contract issued. Because the cedant and the reinsurer are parties to the same reinsurance contract, their rights and obligations are symmetric. That's to say, the rights of the cedant become the obligations of the insurer, and the rights of the reinsurer become the obligations of the cedant. Since the boundaries of the reinsurance contract are determined by reference to the rights and obligations of the cedant and the reinsurer, the boundaries of the reinsurance contract held and the reinsurance contract issued should be the same. However, because the insurance contract entered into by the cedant with the policyholder is a separate contract from the reinsurance contract, the rights and obligations arising under the underlying insurance contract are not directly related and symmetrical to the rights and obligations arising under the reinsurance contract. Therefore, the boundaries of the underlying insurance contract and the reinsurance contract may not match. The parts of this table that we need to look at are the rights or obligations of the insurer, cedant, and the insurer in a reinsurance contract. First, let's look at the cedant rights and obligations in the insurance contract, which are shown in the middle column of this table. The cedant right is determined as a right to receive reinsurance services. It ends when the reinsurer has a practical ability to reassess reinsurance premium, or when the reinsurer has the right to terminate the contract unilaterally. The cedant obligation is defined as the obligation to pay the reinsurance premium. It ends when the cedant has the right to terminate the contract. Next, let's look at the reinsurer's rights and obligations in the right-hand column. The reinsurer's right is defined as the right to compel the insurer to pay the reinsurer's premium. It ends when the cedant has the right to terminate contract unilaterally. The reinsurer's obligation is defined as the obligation to provide reinsurance services. It ends when the reinsurer has the practical ability to reassess the reinsurance premium, or when it has the right to terminate the contract unilaterally. As a result, the rights and the obligations of the cedant and reinsurer in a reinsurance contract and the time of terminations are symmetrical. The reinsurer have determined the contract boundary of its reinsurance contract based on the information summarized in this table, which is based on the requirement IFRS 17 and discussion result of the insurance TRG. The insurer has subdivided a treaty for accounting purposes into different parts based on the underwriting year of the underlying insurance contract, and has adopted the accounting policy of treating each of the subdivided parts as a contract for the purpose of determining the contract boundary. In accordance with paragraph B64, the contract boundary is reassessed at the end of each reporting period. Therefore, we can say that the contract boundary changes over time. That's to say, it could shrink or expand. However, in the case of reinsurance contract that provide both the cedant and the reinsurer with an option to renew or terminate the contract with notice, if the cedant and the reinsurer do not announce a cessation of ceding new insurance, there is no change in circumstances that would result in a risk assessment of the contract boundary as determined on initial recognition. This conclusion is based on the discussion result of the insurance TIG in September 2018. According to the agenda paper AP5 in September 2018, the likelihood of the renewal or termination options being exercised was not assessed in determining contract boundary on initial recognition. The additional cash flows from these options do not reflect cash flows arising from the substantive rights and obligations of the existing contract, but rather relate to the rights and obligations of a future contract. Therefore, paragraph 35 of IFRS 17 applies in the circumstances, and these additional cash flows will be recognized as a new contract when the recognition criteria for the new group of insurance contracts are met. We now consider by way of example how to determine the boundaries of each of the 4 types of reinsurance contract, which are determined by the existence of rights and obligations of the cedant and the reinsurer. I'd like to emphasize that the contract boundary ends only when the rights and the obligations of the cedant and the reinsurer end. Therefore, only the first type corresponds to the situation where the boundary of the contract ends at some point before the maturity of the underlying insurance contract. As you can see from the table at the top of this slide, the rights and the obligations of both cedants and the reinsurers. So I just deal with the rights and obligations of the cedant. First, let's look at the contract boundary for the first type of reinsurance contract, where both the cedant rights and obligations exist until the maturity of the underlying contract. In these cases, in conclusion, cedant rights continue until the maturity of the underlying contract because the insurer cannot unilaterally terminate the contract without the consent of the cedant. In addition, cedent obligations continue until the maturity of the underlying contract because it cannot unilaterally terminate the contract without the reinsurer's consent. Therefore, we conclude that the contract boundary continues until the maturity of underlying contract. Following slide describes the contractual boundaries for the second type of reinsurance contract, where the cedent rights continue until the maturity of underlying contracts, but cedent obligations don't. In summary, in these cases, cedent rights continue until the maturity of the underlying contract because the insurer does not have the right to terminate the existing reinsurance contract unilaterally. However, cedent obligations ends at a certain point in time because cedent retains the right to terminate the contract unilaterally at a certain point in time. Finally, although cedent obligation ends at a certain point before the maturity of the underlying contract, we can conclude that contract boundary continues until the maturity of underlying contract. Next slide describes the contract boundary for the third type of reinsurance contract, where the cedent obligation exists until the maturity of underlying contract, but cedent rights don't. In summary, cedent obligation continue until the maturity of the underlying insurance contract because the cedent has no right of unilateral termination at renewal. And also cedent rights end at renewal because the insurer can recalculate the reinsurance premium to fully reflect the risk at renewal. Finally, although cedent right ends at renewal before the maturity of the underlying contract, we can conclude that contract boundary continues until the maturity of underlying contract. Following slide describes the contractual boundaries for the first type, where both the cedent rights and obligations end before the maturity of underlying insurance contract. In summary, in these cases, cedent rights end at a specific point of time because contracts that terminate if no agreement is reached are interpreted as if both parties have the right to terminate the contract unilaterally. In addition, cedent obligations end at a specific point in time for the same reason as the right. Finally, we can conclude that contract boundary ends at a specific point in time before the maturity of underlying contract. This slide shows how to determine the contract boundary, taking into account future cash flows from new underlying insurance contract to be issued and ceded in the future. In this table, the first case has kind of always 3 months notice clause. Because of this clause, the ceding of new underlying contract can be discontinued after 3 months. The second case contains kind of 3 months notice as of 31 December's clause. Due to this clause, the ceding of new underlying contract can be stopped at the end of December. Finally, the third case is not notifiable after some point in the future's clause. As a result of this clause, the ceding of new underlying contract may be discontinued at a certain point in the future. In these cases, it's necessary to estimate and recognize the future volume of new underlying insurance contract until such time as the ceding of new contract can be discontinued. This means that it's very important This means that future cash flows from underlying insurance contract to be issued and ceded in the future could be within the contract boundary of the insurance contract. Let's now turn to the accounting policy regarding investment component. The issues we will examine in relation to investment components are the identification of investment component, the accounting for differences between the expected and the actual, and the allocation of profit commission for the measurement of investment component. Let's start with the accounting policy related to the identification. In preparation for the adoption of IFRS 17, the reinsurer reviewed whether there are investment components in its reinsurance contract. Under IFRS 17, an investment component is defined as the minimum amount that an insurance contract requires the entity to repay to a policyholder in all circumstances, regardless of whether an insured event occurs. As a result of the review, the reinsurer concluded that profit commissions, which are mandatory ex post reimbursement from the reinsurer to the cedent, taking into account the loss ratio with the definition of an investment component. However, the reinsurer also concluded that in the case of the insurer's contract, where the cedent only sees risk premiums, there is no investment component related to surrender or maturity refund. Let's read through the relevant paragraphs of IFRS 17. Due to the time limit, I would like to skip this slide. Therefore, the reinsurer adopted an accounting policy that identified the cash flows corresponding to the investment component under the terms of the contract to distinguish between the investment and insurance component. Let's consider a simple example illustrating the investment component identified in a reinsurance contract. There is a reinsurance contract with a reinsurance premium of 1,000 and a profit commission rate of 80%. Assume that cases 1 to 4 are all possible future scenarios, each with a different loss ratio. The profit commission is calculated by subtracting the loss ratio commission from the reinsurance premium and multiplying by the profit commission rate. The sum of the loss ratio commission and the profit commission is the total commission. Looking at cases 1 to 4, we can see that the amount of commission paid to the cedent is the smallest in case 1, 800. This amount corresponds to the definition of the investment component described earlier. Let me read the definition of the investment component again. The minimum amount that an insurance contract requires the entity to repay to a policyholder in all circumstances, regardless of whether an insured event occurs. The next issue for investment component is how to account for differences between an investment component expected to be paid in the period and the investment component actually paid. Paragraph B96C of IFRS 17 requires an adjustment to the CSM for changes in FCF that relate to future service. The difference between the expected and actual investment component comprises these changes. However, the reinsurer adopted an accounting policy that the difference arising on the insurance contract, where the cedent only sees risk premiums, should be recognized in profit or loss. Paragraph BC 235 of IFRS 17 describes that any unexpected repayment of an investment component shall be adjusted in the CSM, and the resulting changes in future cash flows shall also be adjusted for in the CSM. It's because the net effect of the CSM reflects the effect of the change in the timing of the repayment of the investment component. In particular, the paragraph assumes that net premium reserves where the concept of early or deferred repayment exists, but the reinsurer sorry. Let me start again. It's because the net effect on the CSM reflects the effect of the change in the timing of the repayment of the investment component. And therefore, it concluded that the difference between the expected and actual investment component is largely unrelated to future services and shall not adjust the CSM. I'd like to skip the allocation of profit commission due to time limit, sorry. This brings us to the final section of my presentation.